I continue to see this really bifurcated market play out where as long as the cyclical economy is slowing, which I believe it will continue to do, all of those cyclical assets that I mentioned, the assets that have not really performed well at all, in many cases not making new highs since 2022, will continue to be poor performers. But I can't say that the S&P 500 or the tech-heavy NASDAQ are at immediate risk until the labor market deterioration gets much more pronounced. So I think that we're going to continue to see a bifurcation in asset markets from that standpoint.
Hey everyone, and welcome to another episode of the WTFinance podcast. Today I have the pleasure of welcoming back popular guest Eric Basmajian. So Eric is the founder and CEO of EPB Business Cycle Research. Eric, thanks so much for coming back on the podcast today.
Hey Anthony, good to be with you again.
Yeah, really looking forward to the conversation. I think we've done this a few times now, and interested to see where we are in the business cycle. But yeah, what I like to do with all my interviews is start very broad. So what do you currently see in the economy?
Yeah, so the way that I look at the economy is I separate it into several different buckets, 4 buckets to be specific, because there's a certain sequence or an order of operations in which the economy moves. And it's really difficult to give a high level interpretation of where the economy is for all people at all times, because so many different sectors of the economy move before the average and some move after the average. The example or anecdote that I like to give is that if you were at a cocktail party in late 2006 or early 2007, and you were in the residential construction sector, you would have said that the economy was deeply in recession. But if you were in the services economy, you would have been experiencing some of your best years ever in 2007 and even into the beginning of 2008. So it's difficult to say exactly where we are in the business cycle, just giving one broad generalization. But what we can do is we can look at the whole sequence and look at where the sequence is trending and what that tells us about what may be happening next. So when we do that, we look at 4 different buckets, or what we call 4 economies at EPB Research. The first bucket is what we call the leading economy or leading indicators. These leading economy variables are not measuring any growth or any employment. This is all monetary variables, applications, permits. We're measuring the availability of money and credit, as well as things like soft commitments. And when we look at those leading economy variables, what we see is a continued downturn, which means that there is slowing or there is negative economic momentum still being pushed through the economic pipeline. That's been the case since the Fed started tightening monetary policy in 2022. And it remains the case today as the Fed funds rate is still above 4% and the yield curve is still either very flat or inverted, depending on any day that we look at the curve. So that first bucket, that leading economy, which doesn't necessarily apply to any individual person, it's just measuring the availability of money and credit, is still pretty tight and it's still pushing some slowing pressure through the economy. Then we move on to our next bucket, what we call the cyclical economy. Now, this is the first time that we actually measure growth and employment, but we're only measuring it for the residential construction sector and the manufacturing sector. The reason we focus on these 2 sectors is because they're the most volatile, they're the most interest rate and credit sensitive, so they're always the sectors of the economy that respond first to changes in the availability of money and credit, either easing or tightening. When we look at that cyclical economy bucket and that growth and employment of residential construction and manufacturing, what we see is that those sectors have been contracting for about the last 25 months. Let's call it 2 years. But the rate of contraction or the magnitude of contraction has been extremely mild. So we've been in a very prolonged slowdown in the cyclical economy, but it's been extremely mild in terms of magnitude. Because it's been so mild, it hasn't yet spilled over into the third bucket, which is what we call the aggregate economy, which is what most people look at. The Federal Reserve, the financial media. This is things like the unemployment rate, total non-farm payrolls, personal consumption, things that aren't really going to give you a good warning sign of where things are headed, but are actually the definition of the aggregate economy. And then the services economy, for most people in asset markets and asset allocation, is not highly relevant because it moves so late. So we can, for the most part, ignore that fourth bucket or that services economy for this breakdown. So where we stand today is we have leading variables that are still contracting, that's pushing slowing pressure through the economy. That slowing pressure is showing up in the cyclical sectors of residential construction and manufacturing, but it's showing up very mildly and very gradually, which is not enough to push any real material slowdown into the aggregate economy. Now, because we've been in this bifurcated state where cyclical sectors have been contracting for about 2 years, but it hasn't spilled over into the aggregate economy, that's led to a real divergence in asset markets between mega cap technology stocks, for example, that are more services oriented. They continue to do very well because there's no slowing pressure there. But when you look at more cyclically oriented assets, whether it be small caps, some emerging market and international, and even some real estate assets, they've been performing quite poorly for that really 2 year, even 2.5 year duration. You also see that same bifurcation between Main Street and Wall Street. Wall Street, again, tied mostly to the mega cap blue chip indexes, while Main Street is more tethered to the actual industrial cyclical economy. So that's the best definition of what I think or where I think we are across the business cycle sequence. We have some negative pressure going on in the cyclical sectors. That negative momentum will undoubtedly continue given what we see in the leading economy, but it is going to take quite a bit more downside before we see that pressure show up in some of the more aggregate and lagging economic statistics.
Okay, yeah, I really always enjoy when you lay it out like that and everything that you're looking into. So would you say if the trajectory stays the same at the current rate of sort of economic reduction, especially in the leading indicators, that it would be sort of a mild recession, I guess, in 12 months or so, or how do you sort of gauge that?
Yeah, so what's going on is when we dive into that cyclical economy, when we dive into that construction and manufacturing, because that cyclical economy really is the driver of everything. That's where recessions live and die. All recessions begin in residential construction and or manufacturing, usually both together. It can be one or the other. Usually it's both. As I mentioned in the beginning, we're measuring growth and employment for those two sectors. Now, what we do in our client reports that we publish every month is we break down the nuances of that cyclical economy and we separate the growth or production elements and the employment elements. When we do that, what we see is a very interesting and somewhat unusual dynamic. The production or growth elements of the cyclical economy. So you can think of how many units are we moving off the manufacturing floor? How many apartments are we building? How many houses are we building? The unit volume of production. When we look at those measures, we see a fairly pronounced downturn that is on par with many of the past recessions. We're seeing about a 7, 8, 9% decline peak to trough in those production elements. But when we look at the employment components of the cyclical economy, we're not seeing any material decline in the employment components of those cyclical sectors. So when we think about it, how many units are we producing and how many people does it take to produce those units? We're seeing the number of units of production drop quite rapidly, but the number of employees holding flat. The holding of those employees is what's preventing that cyclical economy from having a more pronounced downturn and spreading into the aggregate economy. Because at the end of the day, it really does come down to the labor market. You can't have a recession without the labor market contracting, and the contractions in the labor market always begin with those cyclical sectors. So you say, how could that be? How could we have companies that are producing fewer and fewer units with the same number of employees? That's got to come out of profit margins. And it is coming out of profit margins. But what's happened is that profit margins in the aftermath of the pandemic, primarily due to such excessive stimulus, were pushed to such extreme levels, the highest levels that we've ever seen in recorded history, particularly in residential construction and manufacturing, that companies have been able to drop their level of production as demand has faltered, hold employee headcount flat, and just take the difference in margin compression. And we've seen about a 400 basis point compression in residential construction margins and manufacturing margins. But because margins were pushed to such an extreme level, that 400 basis point compression still hasn't gotten us to where we were before the pandemic. So that is allowed these companies to hold employment flat, sort of preventing that economy, that cyclical economy, from having a substantial enough downturn to bleed into the aggregate economy. So we do still have some cushion for companies to absorb more margin degradation before they have to start aggressively shedding headcount. So that tells me that while this slowdown is going to continue, it does have the potential to be mild for the next several quarters while companies are able to absorb that margin hit without getting rid of so many employees. And I'll share my screen really quickly. I have a chart that I publish in the client reports, which shows these profit margins. And you could see for the residential sector, residential margins were about 10% before the pandemic. They were pushed almost to 20%, which was the highest level ever, above where we were in the 2006 peak in the construction cycle. And for the last 2 years, margins have been falling. They've fallen about 400 basis points, but we still have cushion to where we were. The same thing happened in the manufacturing sector. Margins were pretty stable prior to the pandemic at about 10%. They exploded almost up to 16%, and we've seen that 400 basis point compression down to 12%. Again, still about 200 basis points elevated to where we were. So it does look to me like companies do have some margin cushion left where they're going to be able to absorb some of this pressure. Now, the stock prices of the residential companies may not like margin degradation, but from the standpoint of how the whole economy develops, to push us from a contraction in that cyclical economy to a broader contraction in the aggregate economy, we need to see more aggressive declines in the employment components. And that may not come right away as long as these companies have some margin cushion that they're willing to absorb.
Okay, and do you think, because if I look at both of those charts, it was sort of 10% was the average before you say the COVID. So do you see once it gets back down to 10%, that's when companies be like, hang on, we actually need to maybe lay off some people?
Yeah, that's the $1 million question, right? Do companies respond based on the rate of change in margins, or do they respond based on levels? And we don't have a precise answer to this because the level at which layoffs start is somewhat different cycle to cycle. It's not incredibly precise, but it does tend to cluster around a certain level. So I wouldn't expect aggressive layoffs to come if we're 400 basis points above, but I can't say for sure that the layoffs won't start at 11% this time instead of 10 or 9% instead of 10. That's a little bit difficult to say. What we can say, though, is that as margins have rolled over and have started to decline, even though they're very elevated, we have seen companies take all of the initial steps that they normally do to protect margins. Now, all of those initial steps are what we group into what we call leading employment indicators, because it's capturing employees saying, my margins are compressing. I have to take a couple of initial, but not super binding steps to protect these margins or slow the rate of decline. So what do? They cut the hours of their employees instead of firing them. They freeze new hiring, so they don't bring in any new people. They may scale back on new orders or new permits. They may even cut some temporary help workers. All four of those things are less binding steps that companies do before getting to actual layoffs. And we do see all of those things happening right now. We see an extremely low hiring rate, which we can gather from the JOLTS report in both the manufacturing sector and the construction sector. We see a pretty sharp decline in the hours worked in the manufacturing sector. We've seen very substantial declines in temporary help workers. So even though margins are super high still, as soon as they started to roll over, companies immediately took some of those initial steps, which is potentially why it's taken over 2 years for these companies to experience just a few hundred basis points of margin degradation. So the fact that they're already taking a lot of those initial steps may tilt us towards the fact that they may lay people off slightly earlier than that 10% level before the pandemic. But we can't say for sure. We're just going to have to watch, on a month-to-month basis, watch those margins and watch the employment in the cyclical sectors. Now, in our reports, we of course publish every month what the breakdown of the labor market was in those cyclical sectors of construction and manufacturing. But then we also go into the granularities of within those two sectors, what are the subsectors that normally lead the decline? So, for example, within manufacturing, motor vehicles is generally a pretty big swing factor. So we're looking to things like that as well.
Yeah, okay, it's really interesting. And I guess the challenge as well in the US is it's very regional. So there's some, some states which are, I guess, Florida and parts of Texas, which are potentially we're seeing this decline. Whereas I think, it sounds like Northeast is doing a little bit better. So how does that play into it?
Yeah, it's a really important point. So especially in the housing market is where that regionality really comes in. The problem in the housing market or the construction sector, really, when we say housing market, people immediately jump to home prices. But in our framework, when we talk about housing, we're really talking about construction activity, residential construction activity, the building of apartments and the building of single family homes. We're not really talking about home prices. That's a little bit different. The problem in the US is that the concentration of construction activity is in so few states. We see a lot of construction activity in Florida, Texas, Nevada, Arizona, parts of Colorado. And those states have had a lot of building over the last few years. They're seeing rising inventory, and many of those states that I mentioned have inventory levels that are higher than they were before the pandemic. So these companies are slowing down their rates of construction in those sectors, which is why those production elements are falling. There's really not a lot of building that goes on in most of the country, whether it's regulation or whatever other factors are playing into it. But like you mentioned, in the Northeast, New York, New Jersey, Connecticut, and then you move over to places like Chicago, there's so little new construction activity that over the past 2 or 3 years, they didn't have the big boom in construction. And the inventory, the housing inventory in those states is still 30, 40, 50, and in the case of Connecticut, 70% lower than it was before the pandemic. There's just not a lot of construction in those areas. So there's not a lot of construction crews, and there's not a lot of construction employment tethered to those states. We are seeing, the more southern district states have pretty elevated levels of inventory. So we're going to see those construction companies slow their rate of permitting in those states, which they're already doing, slowing the rate of construction activity in those states, which they're already doing. They're trying to keep their employment staffing at the same level, and they're absorbing it in margins. But as that margin degradation continues to heat up, which it will, given the dynamics of less production but same level of employees, then they're going to either have to slow their rate of production even further, or one of these companies or many of these companies will begin to lay off some of their staffing. Then that will show up in the aggregate, employment statistics that we look at, and that's what will, push the sequence through to where the slowdown is not just concentrated in the cyclical sectors, but starts to proliferate and get a little bit more diffuse throughout the rest of the economy.
Okay, really interesting to hear that, as you said, the different dynamics between the states. And I imagine that it's challenging to sort of disconnect the impact of tariffs or the threat of tariffs from the data. So how are you looking at that? And this is going to be published next week, and let's be honest, who knows what
Yeah,
things will be happening next week?
it completely depends on what day we're talking, right? So as far as the tariffs, in all of my client reports, I have not opined much on tariffs or psychoanalyzing President Trump, which a lot of people try and do, and they say, well, he's gonna back off, or he's gonna put them back on, or all these types of things. And I have no insight into the mind of President Donald Trump. I like to just watch the sequence of economic events. I have a framework that we publish, and the framework is extremely consistent. Any slowdown or acceleration that happens in the economy always snakes through the economy from leading to cyclical to aggregate to lagging. The interesting thing about tariffs is that the impact of tariffs is mostly on the goods economy, manufacturing, construction materials, things of that nature. So our focus on the cyclical economy will pick up any changes that are happening as a result of tariffs, whether these construction and manufacturing companies are negatively impacted or not. The other thing that we're focused on is profit margins. That's another place where the impact of tariffs will show up, particularly in that goods economy of construction and manufacturing. If these tariffs are genuinely put in place and are starting to be absorbed by companies, we'll be able to see whether they're passing those through to consumers or if they're absorbing it in their margins. So rather than try and guess what's happening with tariffs or where tariffs will be, I take the approach of trying to build the most robust and consistent framework and just watching it snake through the leading to cyclical to aggregate data. As of right now, we've had these tariffs threatened, put on, somewhat being collected, somewhat not, pauses, all the things that have happened. We don't see a huge impact yet, at least in the data that I am tracking. The one area in particular that I'm focused on that I think is interesting is the motor vehicle sector. There's a lot of tariff news on motor vehicles and exemptions and not exemptions, but one of the more vulnerable sectors that I see in my data, and one of the most important sectors as far as the manufacturing sector is concerned, is that motor vehicle manufacturing. So I'm focused on that narrow sector to see how tariffs impact that part of the economy. That sector, the motor vehicle manufacturing, has the lowest margins. So it would take the least amount of pressure to tip them into actually negative margins and then pretty aggressively shedding headcount. So, I don't have any special insight into where tariffs are going or what the deal there is, if they'll be delayed or not. I just want to see it come through the data. As of right now, we haven't seen a whole lot, although there are a couple of anecdotes that are starting to pop up. For example, in the Q1 GDP data that we just got, we did see a pretty large decline in economy-wide profits and economy-wide profit margins, not just the cyclical sectors, for the entire economy as it's reported in the GDP data. It's only a quarter. It's a pretty volatile series. We can't say for sure whether it's from the tariffs or not, but it's something that caught my attention because that's where I would expect it to fall out.
Yeah, interesting. And nothing yet in inflation either, or sort of the drivers of inflation.
We don't see a whole lot in inflation yet. Some people say the tariffs haven't started to bite yet. Hasn't really come through in a meaningful way in the inflation data. The other place I'm looking at is the weekly jobless claims. We're pretty focused on those. No material pickup in the jobless claims. Even when the tariff numbers on China were extremely aggressive and we had all of this news of the ports freezing, and we had a lot of people coming out and saying that there were going to be mass layoffs imminently, that was a legitimate risk. The economy did seize up pretty good, especially with those on the ports. I was watching every week to see, is this trickling through into the jobless claims data? Is anyone at the ports being laid off? Is anyone in the trucking sector being laid off because of the drop in volume of goods coming in? We just didn't see it. Then the tariffs got delayed, and we're still not seeing huge picks up in jobless claims. We're seeing a steady rise week after week after week. Jobless claims are ticking up, but they're ticking up rather slowly, which is consistent with the thesis that I outlined in the beginning of this conversation, which is that the cyclical sectors are slowing, but they're slowing really slowly. And that's pretty consistent with what we're seeing in the jobless claims data as well. So directionally, economy is slowing, or to put it more precisely, directionally, the cyclical sectors are slowing. It's been really slow, and it has not yet translated into really material slowdowns in the aggregate statistics that catch most people's attention, like the unemployment rate or consumer spending.
Yeah, okay, really interesting. So how do you see this impacting markets? Obviously, as you said, it seems like margins are going to coming down, and they're probably going to come down from record high. So I imagine you see that could be potentially negative for many of these companies.
Yep. So as far as markets, I continue to think we're going to have this really bifurcated market experience where, if you look at when the cyclical economy started slowing, it was at the end of 2022, beginning of 2023. And you look at something like the Russell 2000 has not made a new high since 2022. If you look at real estate prices, specifically on the commercial side, Green Street is a company that provides a property price index. They break down apartments, office, self-storage, and all the different categories of commercial real estate. We see that the peak in most of those commercial real estate prices was 2022, with some of these sectors down 15 or 20%. Emerging markets also been pretty weak for the last couple of years. Cyclical currencies have also been pretty weak for the last couple of years. What's really performed well is the S&P 500 and NASDAQ, the blue chip index heavy parts of the market that are really derivatives of the labor market and passive flows and big buyback bids, more tied to services, aggregate economy statistics. So I continue to see this really bifurcated market play out, where as long as the cyclical economy is slowing, which I believe it will continue to do, all of those cyclical assets that I mentioned, the assets that have not really performed well at all, in many cases not making new highs since 2022, will continue to be poor performers. But I can't say that the S&P 500 or the tech-heavy NASDAQ are at immediate risk until the labor market deterioration gets much more pronounced. So I think that we're going to continue to see a bifurcation in asset markets from that standpoint. As far as interest rates, because the cyclical economy is weakening, the Fed's not going to be able to raise interest rates at all. And I do think that the Fed is going to continue to slowly walk down the front end of the interest rate curve. We oscillate in between 0 to 2 cuts when things get pretty optimistic. Then we swing over to 4 to 6 cuts when things get really pessimistic. Interest rates have been in a pretty tight range, or maybe not a tight range, but certainly in a range since 2022. They really have gone nowhere. Just these emotional swings between, we're not going to cut at all. Maybe we're going to hike, and then maybe we're going to cut a lot. So I continue to think longer term interest rates will have that range bound pattern where you probably want to be a buyer when interest rates get to the top end of the range. You probably don't want to press too much when interest rates get to the low end of the range until we see more labor market deterioration. That's probably more for the middle and long end of the curve. The front end of the curve has been grinding lower and lower and lower. And I do think that will continue to be the path forward for treasury rates there.
Yeah, okay, makes sense. And I know there's sort of a lot of data going around, and I'm not sure if it's something you track, where there's quite a lot of institutional investors have lots of money on the sidelines. They sort of withdrew because of the uncertainty. So do you see that money? Do you think it will come into the market, or do you think people will be patient and sort of stay on the sidelines? Is that something that you look at, or not really?
I don't look at it too closely. One thing I do look at is, I look pretty closely at the monetary aggregates, the money supply aggregates. And, you know, a lot of people look at the money market funds, which are a part of the money supply, and they use that to say there's a lot of money on the sidelines and that money's going to come in. I don't look at it in that sense. What I look at is when money market assets are rising rapidly, which we are seeing, that tells me that asset allocators are willing to accept the interest rate that's offered on government T-bills as opposed to investing that money in the real economy or into more risky assets. Or in other words, the government interest rates or the government is crowding out what otherwise would have been productive investment in the real economy or into growing companies. So when money market assets are rising, that is a symptom to me of tight monetary policy because market participants are willing to accept the interest rates that the government is offering as opposed to investing that money somewhere else. Conceivably, if interest rates were zero, you wouldn't see a lot of money flowing into money market funds. This is pretty symptomatic of traditional monetary tightening cycles where when the Fed raises short-term interest rates and those government T-bills start to offer 3, 4, 5% rates, money flows into those money markets and accepts those rates in lieu of making more risky investments in the economy. So even as the Fed has cut rates from 5.5 to 4.5, we still see a continued increase in money market assets, which tells me that even at a 4.5 or 4% rate, people are willing to accept those interest rates, specifically on the front of the curve, as opposed to making investments in the real economy. And that's, to me, a symptom of still tight monetary policy. That's the way I look at those numbers.
Yeah, no, that's really interesting insights. And I guess it doesn't seem like there's going to be loose monetary policy in the near term unless we do get this, as you said, negative data coming through the cyclical economy.
Yeah, exactly. And that's kind of the conundrum that we've been in for the last 2 or 3 years, which is everyone wants the interest rate cuts, but the interest rate cuts will only come when the labor market deteriorates. And then, that comes with negative economic consequences. This is the big conundrum in the real estate sector where, everyone in the real estate sector wants interest rate cuts so they have lower financing costs, but they also want the labor market to stay intact because, in real estate, you have the cap rate, which is, predicated mostly on interest rates, but then you have your net operating income, which is mostly a function of, what type of rents you're collecting, what type of vacancies you have, what type of, delinquencies that you have. So it's been a battle in the real estate sector between wanting those lower interest rates and the Fed's not giving it to them because the labor market hasn't deteriorated enough. Once the Fed does start to cut interest rates, it's likely to be because the labor market's deteriorating. Then the real estate sector will get lower interest rates, but they'll probably have stress on their NOIs or net operating income as a result of the labor market deterioration. So I agree with you that the Fed's going to slowly walk interest rates down. But unless the labor market, falls apart really rapidly, particularly in those cyclical sectors, you're not going to get major declines in interest rates. And if you do, it's likely not to be for good reason.
Yeah, really interesting. So Eric, thanks again for your time today. Really appreciate it. We've covered so many things. So my last question is, what is one message you want people to take away from our conversation?
The biggest thing that I want people to take away and the biggest focus of all of my work is that the economy does move in a sequence. It's a repeatable sequence. It's the same sequence in every business cycle. The lead and lag times between the leading economy and cyclical economy or cyclical economy and aggregate economy are different from cycle to cycle, and they are rather unpredictable. You could get averages and you can get clusters and give you some bias of what the average lead and lag time is, but it really is different cycle to cycle. The sequence, though, is always the same. So I really want people to take home that you should be tracking a sequence of how economic data moves from monetary and credit aggregates through the interest rate sensitive sectors, then into the aggregate economic statistics, and then into the lagging economic statistics. And when you do that, you can get a much more precise reading on what's happening with the economy. And when you analyze the economy, you really should be analyzing it on a sector by sector basis rather than trying to say the economy is here, because that's maybe true for the average person or the average business. But if you're a business that falls way before the average, or you're a business that falls way after the average, your lived experience is going to be far different than those average statistics. So the biggest takeaway is that the economy is a sequence. It moves in a very repeatable way. And what we offer to clients is that business cycle framework, that sequential framework, and we update that on a weekly and monthly basis.
Yeah, great message. And so I'm guessing that's where people can find all the work you do on your research website.
Yep, you can follow me on Twitter or X at EPB Research. But for all the work that we do, you can just go to epbresearch.com. We have links there that could take you to our free blog where you can get some information, and our client services and consulting services are also listed there as well.
Great. I'll put it in the description below, but thanks again for your time.
Thanks, Anthony.
Hey, everyone. Thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching, and see you on the next show. And you also might like this video right here. All right. Thanks again.